club. Ren's reading the book, so Bryce doesn't have to.
Nice.
Yes.
We're back.
Yes, we are back for book club.
Holiday reading.
Pardon?
Holiday reading.
Yep, a holiday reading. Nothing better than reading about investing while in the Mediterranean. Would suggest it. But Jim Simons, the founder of Renaissance Technologies, one of the best investment funds to ever do it. He died earlier this year, so we thought it was time to read the book about him, the man who solved the market, how Jim Simons launched the quant revolution. And I've got 4 takeaways. So
Right.
four big things. We're going to do this listicle style.
Love it. Love it.
First big takeaway, the power of teams.
Okay.
Now, one of my big gripes with most business books is this Americanized view of business, this Ayn Randian, great man theory of business, where it's a solo entrepreneur, it's Elon Musk or Jeff Bezos that builds this multi-billion-dollar company,
Yeah.
which is not how business works. Business is a team sport, and even the best entrepreneurs only get to where they are because of the teams that they build around them.
Okay.
And if you want to debate me about that, let's do it in another segment. But this book really makes it clear how much of a team effort it was. In huge swaths of it, Jim Simons isn't even a main character. There's, like Lenny Baum and James Axe, who developed Renaissance first trading models. Robert Mercer, who's a controversial figure, and Peter Brown, who figured out how to apply their trading models to the stock market, to equities, which is really when they sort of could scale effectively.
What were they applying it to beforehand?
Bonds, commodities, futures, other markets. Yeah. So I think what I love about this...
Renaissance?
Yeah.
Right.
So the thing is, the stock market is so much bigger and so much more liquid that the scale that they got to, trading billions and billions of dollars, they couldn't have got that scale if they didn't figure out the stock market. Yeah. So that's my first takeaway, the power of teams and the importance of teams, and forget this Americanized view of the solo entrepreneur.
Great.
Second big takeaway, how Renaissance made their money. So for context, they delivered 66% a year after fees between 1988 and 2018.
It's unbelievable.
A record that will probably never be matched in terms of absolute returns over a 30-year period. So how did they actually do it? So they sucked in huge amounts of data. That was really their first thing. So Jim Simons and a lot of the guys were all mathematicians. Jim Simons also worked for the NSA and broke codes for a number of years. And then he applied a lot of what he did there to the stock market. He was a professor of maths at Stony Brook University until he was 40. And then he was like, maybe I can figure the stock market out.
Nice.
Yeah.
Nice. This was his second act.
Yeah. Third act, I guess, after the NSA. But that was still as a mathematician.
Maybe I can crack the stock market, and then for 30 years did 66% a year.
Yeah. He had a good team around him.
That is unbelievable.
So they found huge amounts of statistical data, and then they looked for statistical correlations. If this happens, how does it react?
Yep.
Or even not a correlation, like a subsequent event. So when a stock falls 4%, what happens the day after?
Yep.
And stuff like that. And so they were just crunching an ungodly amount of data, especially an ungodly amount of data for the 1980s, and just finding correlations. So they couldn't even explain the why with a lot of these correlations. It was just
doesn't matter.
Find the correlation, and is it a statistically significant and predictable correlation?
Yeah.
Does it happen every time?
Yeah.
In the early 2000s, they were making between 150,000 and 300,000 trades per day.
Holy shit.
Yeah. But they're not high-frequency traders. So if you've read Flash Boys or you've heard about high-frequency traders who essentially front-run an order, and they'll get in front of it and make a tiny little spread and then sell it on. That's not what these guys were doing. They were just trading a heap. Robert Mercer was once quoted as saying, "We're right 50.75% of the time."
Wow.
So it was
just
over half. Yeah, just a pass mark if you're at university. And And then they just leveraged. They figured it out. They figured out how to make money, and they just leveraged. Traditional funds were sort of 7-to-1 leverage. That's what you might sort of find, at least according to this book. By the early 2000s, banks were willing to let Renaissance lever up 20-to-1. So in 2002, they had $5 billion of investors' money, but they were trading $60 billion, which isn't even 20 times leveraged. So they could have gone more.
And so this was just all done completely by computer. That was it. They just plugged in, if this happens, make a trade. If this happens, make a trade.
So originally the brokers weren't sophisticated enough. So it was the computer was spitting out what they should do, and then they were calling. But eventually,
you can't do that 300,000 times a day.
So that was only enabled by technology improving.
Wow.
Yeah.
Wow.
So that's the second one, how they made money.
Have they ever... Sorry, keep going. I'll ask at the end.
Okay. My third big takeaway, that what they did changed the world. So they invented quantitative investing, essentially. They were the pioneers of it. They weren't the only ones that were doing it at the time. D.E. Shaw were another firm that were doing something similar at the time. People who are familiar with Amazon's history might recognize that name. That's where Bezos worked before he left to start Amazon. And also long-term capital management were doing something similar. They're famous for blowing up in spectacular fashion. But so there were others trying to do it, getting just ungodly amounts of maths PhDs in a room and trying to figure the market out. Renaissance just did it the best. By 2019, quant trades were almost a third of all stock market trades.
Wow.
So it just changed what they did changed the stock market. And that 2019 level was more than double 2013 levels.
Wow.
So you can just see how quickly it's growing.
Yeah.
Yeah.
Any stats on what it is today?
No.
Yeah. You'd think a lot higher.
Yeah, definitely. Yeah. Here's a fun fact. This is just about the amount of data being created. IBM estimate that 90% of the world's data sets have been created in the last 2 years, and that 40 zettabytes, which is 40 trillion gigabytes of data was created by 2020, which was a 3-fold increase from 2005.
Wow. So it's like the size of compute gets, like, what is it, halves every 2 years or something?
Moore's Law?
Yeah,
the
Moore's
speed
Law.
of compute.
Yeah, it's like the same here. Like the increase in data is just going to be exponential year on year.
Yeah. Okay, so that's my third one, that what they did change the world. And then my fourth takeaway is the effect of money. So this is where the Robert Mercer story comes to the forefront. And his name may be familiar for US political watchers because he was the big backer of Donald Trump early, the billionaire backer early. A lot of billionaires jumped on board later, but Robert Mercer was the true believer. And he was a true believer. They're in like big fundraising circles. A lot of people talk about political donations and then talk about what the donor expects, access or whatever. But everyone couldn't understand Robert Mercer because he was an ideological warrior. He gave money because he truly believed, not because of what it would do.
Yeah.
But here's some of the things he believed. He doesn't believe in man-made climate change.
Good. Good.
He argued that African Americans were better off before the civil rights movement.
Okay.
And then like a whole bunch of gun control, like, arming teachers and, good guy with the only thing that stops a bad guy with a gun is a good guy with a gun. Like all of the...
Dangerous.
He's a pace, essentially.
Yeah.
Good mathematician by the sounds of it. But but he funded Breitbart when it was Andrew Breitbart. So he gave him a heap of money, and then when Breitbart died, he backed Steve Bannon to take it over, and so he was a big backer of Steve Bannon, and he became a central figure in Trump's campaign in 2016, not just because of the money, but also because when Trump's campaign was really struggling, he made the introductions to Bannon and Kellyanne Conway and got them on the campaign. Oh, God. Two figures who became, central to Trump's success.
Yeah, yeah.
So the effect of money. Robert Mercer, he didn't have money before this. He makes his money from Renaissance.
Yeah.
And just uses it in the most destructive ways.
Yes.
Jim Simons, on the other hand, I think, used his money in really interesting ways. So the Simons Foundation emerged as America's second largest private funder of research in basic science. He helped found Math for America, and I love this model. So what they did was they gave a $15,000 stipend to the top 1,000 maths and science teachers in New York City. So to like stop them going to
somewhere else,
private companies or anything like that, they literally just topped up their pay and gave them an extra $15,000. One, I just think that's a great use of like direct philanthropy. Like, we recognize the value of teachers. We want to keep them in the field. How can we directly just incentivize them to stay? Secondly, all I could think was, imagine being in that top 1,000 list and then falling off.
Yeah,
like
you're 1,001. Yeah, damn it. That's the incentive, I guess.
Yeah.
Stay there.
But like that...
Stay sharp.
It's an interesting model of... you don't really see philanthropy that direct.
Yeah.
Where it's like, we're just going to give you cash to keep doing what you're doing. And then he also paid $75 million for an observatory to search for the origins of the Big Bang, but he explicitly doesn't believe in the Big Bang theory.
Oh, he's just prove it.
He thinks, he's like, this is going to be a win-win. Either we'll prove it and we'll get a Nobel Prize, or we won't prove it and that will go towards my theory.
Yeah.
He subscribes to the bouncing model where time doesn't have a fixed starting point.
Oh, goodness.
So let's not get into that now. But if I never knew about this alternative theory of time and existence. So something for people to Google.
Nice. So there's 4 key things. My big question, though, at the end of it is, so he's passed away.
Yeah.
Renaissance still exists and is still doing its thing.
Yeah.
It's an incredibly private company. You can't put money in it yourself. I think there's
so there's the Medallion Fund, which is employees only, which is like their superstar fund. And then there's a couple of hedge funds available to institutional investors. But part of the book is that all the best stuff isn't used in the funds for others, and that was like a point of tension anyway.
So probably the most valuable thing in all of that is the algos that they've got in the Medallion Fund. How are they, like, was there any talk about how they keep that private? What happens when he dies? So there was and when employees left, because they have like watertight non-competes and stuff, but then a couple got out of them or like didn't sign them in the first place. There was there's leaks. There hasn't been major leaks. Because all you need to do is be an employer, leave, wait it out, and spill the beans.
No, because there's non-compete periods and then non-disclosure periods.
Oh, okay.
You're still signed up to it.
Yeah.
You'd be lifelong.
Yeah. God, I would love to know. Imagine being part of that employee list as well. They'd all be millionaires.
Well, a lot of them are billionaires.
Yeah,
a lot of them are distorting the outcomes of the US presidential election.
Oh, yeah. Anyway, well, thank you, Ren. Firstly, if you have a book that you would like to submit for us to do a book club, then head to equitymates.com/contact. We do have a bit of a list to get through. So, Ren, do we have a book for the next month?
We do. One that is particularly relevant to us here at Equity Mates, but I'm sure we'll have some good investing lessons. The book is by Ben Smith, and it's called Traffic: Genius, Rivalry, and Delusion in the $1 billion race to go viral.
Oh, wow. Okay.
Yeah, so it's about the rise of the BuzzFeeds, the fall of Gawker, HuffPost, like all of those sort of 2010s internet giants. The rise and the fall.
The rise of Equity Mates. Yeah. Nice. All right.
Maybe we'll finally go viral.
Nice. Well, we'll put a link to the show notes. We'll put a link in the show notes to that book if you'd like to download it as well, and join us in a month as we review it.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.